Accounting is often seen as a complex field, full of jargon and intricate financial concepts. However, understanding basic accounting terms can greatly improve your ability to manage personal finances, run a business, or simply engage with financial matters in a more informed way. This video breaks down the top 10 easiest accounting terms, offering simple explanations that will help demystify financial language for everyone. Whether you're a student, a small business owner, or just someone looking to better understand your finances, these terms will serve as a solid foundation. 1. Assets. In accounting, assets refer to anything that a company or individual owns that has value. This includes cash, property, equipment, and even intangible items like patents. Assets are categorized as either current, easily convertible to cash within a year, or non-current, long-term holdings like real estate. For example, your savings account balance or the car you own would be considered assets. 2. Liabilities. Liabilities are the opposite of assets. They represent the debts or obligations that a business or individual owes to others. Common examples include loans, credit card debt, or outstanding bills. In accounting, liabilities are also divided into current, due within 1 year, and non-current, long-term debts. Knowing your liabilities is crucial for understanding your financial health and planning for the future. 3. Equity. Equity represents the value of ownership in a business or asset after subtracting liabilities. In simple terms, it's the amount that would remain if you sold everything and paid off all debts. For an individual, this could refer to the value of your home minus any mortgage owed. In a business, equity is what the shareholders or owners would receive if the company were liquidated. 4. Revenue. Revenue is the total amount of money earned by a business from its operations. This includes sales of goods or services, interest income, and any other sources of earnings. Revenue is often referred to as sales and is the starting point for determining profits. For example, if you run a bakery, the total money earned from selling pastries is your revenue. 5. Expenses. Expenses are the costs incurred in order to generate revenue. This includes everything a business spends money on, such as rent, utilities, salaries, and the cost of goods sold. In personal finance, expenses can refer to things like groceries, rent, or transportation costs. Managing expenses is key to maintaining profitability or personal financial stability. 6. Profit. Profit is the difference between revenue and expenses. It shows how much money a business or individual has left after covering all costs. There are 2 types of profit: gross profit, revenue minus the cost of goods sold, and net profit, the final amount after all expenses, taxes, and interest have been deducted. For a small business, net profit is an important indicator of its financial health. 7. Balance sheet. A balance sheet is a financial statement that summarizes a company's assets, liabilities, and equity at a specific point in time. It is called a balance sheet because it must balance, meaning that the total assets must equal the sum of liabilities and equity. This document helps assess the financial position of a company and is essential for investors, managers, and business owners. 8. Income statement. An income statement, also known as a profit and loss statement, shows a company's revenue and expenses over a specific period, typically a month, quarter, or year. It highlights the company's profitability by subtracting expenses from revenue. This statement provides a clear picture of how well a company is performing financially and is a vital tool for business owners and accountants. 9. Cash flow. Cash flow refers to the movement of money in and out of a business or individual's accounts. Positive cash flow means more money is coming in than going out, which is a sign of good financial health. Negative cash flow means a business is spending more than it earns, which could lead to financial trouble. Monitoring cash flow is essential for ensuring that a business can meet its financial obligations on time. 10. Depreciation. Depreciation is the process by which the value of an asset decreases over time due to wear and tear, obsolescence, or age. In accounting, depreciation is recorded as an expense, which reduces the taxable income of a business. For example, a company may buy a truck that costs $20,000. Each year, the truck will depreciate in value, and the business can claim this as a deduction on its taxes. While accounting can seem intimidating at first, understanding basic terms is an essential first step toward becoming more financially literate. Terms like assets, liabilities, revenue, and profit are the building blocks of both personal and business finances. By becoming familiar with these common accounting terms, you can take control of your financial future, whether it's managing your own budget, tracking business performance, or making smarter investment decisions. The more you learn, the easier it becomes to make sense of the numbers that drive the economy and your finances.